Okay. Our next audio recording deals with time value and the role of expectations. As a prerequisite for that, you need to be familiar with how to use a financial calculator and how to use the time value functions in Excel. Hopefully, the prerequisite course gave you an introduction or insight in how to use a basic financial calculator. If you don't have one, I recommend that you purchase either a Texas Instruments, I think it's called um, it's a TI BA2 Plus. It costs about $30, or a Hewlett Packard. I think it's 10B or something along those lines. Either way, the Hewlett Packard or the Texas Instruments calculator should cost about $30. Um, for Excel, I've posted a spreadsheet and a recording that gives you an overview of the Excel time value functions. And the spreadsheet that provides examples of the Excel time value functions is posted in Module 1 under Materials, and the recording is posted as well. Okay, so if you're familiar with time value and how to use time value functions in Excel, you can skip the recording. If you need help in time value in general, there is a review section in Canvas where I've posted the time value chapters from the prerequisite course that you feel free to avail yourself of. So what we want to then focus on now is the role of time value and value creation, and along with that, the role of expectations. So let's start with a company that has $500,000 of equity, has no debt. The cost of equity is 11%, and since there's no debt, the cost of capital is also 11%. And this firm has a 10-year contract that will get back its initial investment at the end of the 10th year. And again, no taxes and no growth at this point. So we have a company generating with an invested capital of $500,000. Let's assume that this company is generating $55,000 a year for the next 10 years. At the end of the 10th year, you get back your investment of $500,000. If you have a required rate of return, a cost of equity of 11%, what is the firm's value? So to do that, you need to take the present value of the 10-year annuity and the present value of the terminal value at year 10. Again, on your financial calculator, this would be payment. Number of periods would be 10. 500,000 would be your future value. 11% would be the interest rate. And when you solve for the present value, you should come up with a present value of $500,000. Keep in mind when you calculate the present value, if you put in all these numbers as positives, the present value will be a negative. Your calculator, financial calculator, as well as Excel, wants money in, money out. So you need to adjust the sign of the data as needed. And at this point, no value is created, no value is destroyed. The value of the expected future cash flows is equal to our invested capital, the money that we put in of $500,000. Now let's extend the example to say at the end of the fourth year, the company is to be sold. Nothing else has changed. The cash flows are expected to stay the same at $55,000, and the person would get back $500,000 at the end of the 10th year. So now this person is going to be getting 6 years of $55,000 and $500,000, where you are getting 10 years of $55,000 and $500,000. What's the present value of these cash flows at 11%? You will see that the present value will stay at $500,000. That is because even though the seller, in this case you, the seller, is getting less money, only 6 of these, but you're getting your money sooner. The $500,000 comes in 6 years as opposed to 10 years, and each of these cash flows is coming sooner, and they exactly offset each other. As a buyer, your expected rate of return is also going to be 11%, because if you put in a negative 500,000, payments of 55,000, 6 years, future value, solve for the rate of return, you'll come up with 11%. And again, that value needs to go in as a negative, otherwise you're going to get an error. The seller is also going to have a realized rate of return of 11% as shown. They sold their interest, the company, for $500,000. They have received $55,000 for the past 4 years. They paid $500,000. So if you use a financial calculator to solve for the rate of return, you will end up with a return of 11%. Again, negative 500 is your present value, payment 55,000, number of periods 4, future value 500,000, solve for the rate of return 11%. Now let us change expectations to start to understand how expectations or changes in expectations impact value. Similar as before, the company is to be sold at the end of the fourth year. However, we now expect the net operating cash flows to increase to $75,000 a year due to production efficiencies. So, first question is, what will be the price of the business when it is sold? And what return will the seller earn? So we can see that the buyer sees $75,000 a year for years 5 through 10 for those 6 years. Still going to receive $500,000 at the end of the 5th year. That's better. The end of the 5th year, with a required rate of return 11%, the value at the end of year 4 is $584,461. The seller now realizes a return of 14.42% because they bought the business, started the business with an investment of $500,000, received $55,000 for years 1 through 4 and sold the business for $584,611. Using your financial calculator and or Excel, you should have the seller has earned 14.42%. That is to say, the seller, the holder of the asset at the time of the sale, benefits or loses based upon the sale price. Now, the buyer, which you can solve for yourself, will earn 11%. The buyer paid $584, is going to pay $75,000 a year, will get $500,000. If you solve for this rate of return, you'll see that it's exactly 11%. So the person who is impacted from the change in expectations is a holder of the asset at the time of the sale. And the sale price is based upon a change in expectations, not the actual future cash flows. Because if we're sitting in year 4, we expect the cash flows to increase to $75,000 a year for years 5 through 10, but there is no guarantee. It's an expectation. So again, the price moved from 500 to 584 based upon not what actually happened, but based upon the change in expectations. And the change in expectations impacts the holder of the asset at the time of the transaction. If expectations do not change again, then the buyer is going to earn the same 11%. That is to say, the buyer is not going to benefit from the increased cash flows. In fact, the buyer is paying for those, for the expectation of those increased cash flows. This concludes the recording on expectations, really changes in expectations and value. The next recording has a short discussion of how expectations impacted share prices for a series of companies. The articles, really the news clips around these companies are posted. And the recording is called Expectation Articles.